Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you the market wrap up for the week of August 7th, ending August 11th, 2023. So we take a look at the chart here. What we're looking at here is the performance of the three major market indexes: the S&P 500, represented by the SPY, the Nasdaq 100, represented by the QQQs, and the Russell 2000, which is of course the IWM. And then for good measure, we also threw in the TLT, which are the longer term bonds, just for some perspective on the fixed income market there. So if we take a quick look here, what we've done here is we have set this as the 0 point, which is the last Friday. So that was the close of last Friday. So here is all of the trading that transpired since the close of last Friday, concluding this Friday. So we set a 0 point there, and so we create a percent change here. So we can see that the S&P was just a little about 0.3% south of break even, and then the Qs and the IWM, they were sitting at about 1.5%. So this was kind of another kind of consolidation week for the market. Nothing too dramatic, but obviously after kind of the robust move of the prior several weeks, the last couple of weeks have kind of obviously been, there has been some consolidation here. There was, the other day, a couple of days ago, there was actually a robust move during the day, and then it gave back a huge amount. So by the time the smoke cleared, we're pretty much, as we said, well, at least from the perspective of the S&P 500, more or less just a bit below break even. Okay, so anyway, that's what we're looking at in terms of the broad market indexes. If we look at the sectors, we can see last week that energy and healthcare were the strong sectors. So the XLV here, the XLE here for energy. These were the two strong sectors here. We can see that energy was up about 3.5%, healthcare was up about 2.5%, and then on the weak side here, there was this kind of cluster here. We can see, of course, that the XLK, which very closely mirrors the QQQs. That was the weak one here, and that was down about 2.5%, which was pretty much in line with what we saw on the QQQs. And then we also have materials and retail and transports in there, as well as I think consumer staples as well. So excuse me, consumer discretionary. So at any rate, that's what we were looking at in terms of last week. And then if we actually then broaden this out to the rolling month, okay, so this goes back to the week of starting July 10th, going back a month. And so what we're doing is we're here looking at the prior Friday right before that, and then here are the ensuing 5 weeks that have occurred since then. Okay, so if we look at that, we can certainly see here that energy has been by far the strongest of the sectors for this last rolling month, and we're up about 11.5%. And then down here, we can see again, there's tech, the XLK there, as well as utilities, and those are kind of the weak sectors down there. So at any rate, that is what we've been looking at with respect to both the broad market as well as the individual sectors that contribute to its performance. Before I go on here, I do want to just pop up the ubiquitous disclaimer here. We're about to show you some trading levels on some of the equity indexes. Where we're gonna look at some levels where we could potentially be looking at long and short trades from. Before I do that, as of course, the disclaimer: Precision Trading Labs, we are not fiduciaries, we are not financial advisors. So obviously trade with risk control, and we are here to provide trading information and education. Okay, so with the disclaimer done, let's take a look at the charts here. So here's the SPY. And so this is what I was actually looking at last week when I did this video last week, this blue line here, okay? So right before that, we had actually just experienced that minor smackdown that occurred when Fitch, the credit reporting agency, downgraded the U.S. debt from AAA to AA plus. They had made the decision that that our politics here and our politicians are somewhat toxic and don't necessarily take the American people's interest at heart. But took them about it took them about 8 or 10 weeks to figure that out after the brinksmanship of the debt ceiling negotiations, and so it took them about 10 weeks to figure that out. That in fact that our politics might be a little toxic, and that doesn't always get things done efficiently. So it took them that long to figure that out, and so at that point, then they downgraded our debt, and so that was the thing that triggered this gap here. And then what it's done ever since is it sent it down. It sent the SPY down. This is an area right here where you can see this is the origin of a gap here. If I break this out into a 2-hour chart, we would very clearly see an area of consolidation. And so at the time when we did this last week, we had actually said when price had come back here that this level right here might actually stop the descent. So what it's done here is it's kind of been waffling around here and bouncing up and down. So right now it's kind of still stuck in this level here. So this level kind of did half of its job. It did stop price from falling. I don't expect it really to hold really any more than it has now. And so right here, we can see that there is a drop here from that gap. Notice there's a consolidation here with two kind of indecisive candles. These are very wicky. And so this is a kind of a pause here. And then we can see right here, there's a bullish candle, another bullish candle, a gap, and then it kind of goes from there. So this would be an area that I would actually expect that we could actually see a bounce here. So this is where we closed on the 11th. And so if we look at the distance from the close here to the front line of this, what we refer to here as a demand zone, because essentially what happens is there was a consolidation and then an exhaustion of sellers. All of the sellers essentially just disappeared from this area where price kind of shuffled back and forth for about the better part of 3 days. And then all of a sudden, some change of perception happened, and there was no more, nobody else was willing to sell in this area. And so for these trades to have occurred, obviously buyers had to run up the price chart until they found willing sellers. So there was an expectation, because price only spent a relatively small amount of time here, that if we get a pullback into this zone, we can expect that we're going to see a bounce out of that. And at that point, then one can take a trade based on based on this level, and one could of course express that trade in any number of ways. Most direct route, of course, would be to buy the SPY, but of course we could also utilize options, and we could perhaps buy a call. Um, Out of here based on the return to this level at around 440. So we could buy a call. And if we would do that, we would buy a call with sufficient time so we don't get too beaten up by time decay. And we would also buy a call, excuse me, that would be a bit in the money. So that this way we are actually, running a delta of, let's say, 55 or 60. So that if we do get a bounce, we will then, be able to profit from it. So, that's why we're not necessarily in love with buying an option that's way out of the money, because, you may only capture, 15% of the move if you're running a delta of, 10 or 15 or something like that. So our preference would be to buy something, a bit in the money. Obviously, that's going to be a lot cheaper than buying a $440 stock. One could probably buy an option somewhere in the $15 range, and so you get all the benefits of the leverage. You could be running a delta around 55 or 60, and that would enable you to, obviously then express this trade for a lot less. Also, as I said before, we would also want to buy sufficient time. Our preference is we're not going to buy with 2 or 3 weeks out, because if you end up in the trade, and let's just say something like this happened, and you end up, let's say, having to sort of sit through a week of consolidation before you do actually get that bounce. Well, if you're only buying 3 weeks at a time, you're going to get kind of really beaten up by theta, by time decay. On the other hand, if you buy this thing 3 months out or even 4 months out, yeah, you're going to pay more, but then you'll also get that you'll essentially get that time premium back when you then close the position. And so in one case, you might lose, 25 cents in time decay, and in another case, if you're only buying a bit, if you're buying a very short amount of time, you might, end up losing, 60 or 80 cents. So that's the point of being a value shopper when it comes to buying time. So at any rate, this is so this is where we are now. This is the area where we're anticipating that there is the potential for a bounce out of here, and so that's about 5.5 S&P points down from where we are now, and that represents a drop of about 1.2%. Okay, so that's what we're looking at from the potentially a bullish side. Looking above, as I said, this was the origin of where that move came down from the the pullback. Excuse me, the downgrade by Fitch. And if we actually go back in time, and if we go back in time here, we can actually see prices actually return to this region any number of times here. Let me just pull this back here, and if we go back in time here, we can see price has been back here any number of times. Price came in here, consolidated, dropped. Notice we had these two, kind of think of these as almost little double tops here. They came up, dropped out of here. Price came back here, dropped out of here again. Okay, and then it came back and once again. So the price has been back to this region about 6 times. So this region is essentially clearly resistance, but I would not characterize this as supply because of the fact that it is quite possible when price returns to this is not going to hold. The more often price returns to a level like this, the less likely is that there is still, that there are necessarily people that are going to want to sell out of it. So we've already been back here again, as I said, 6 times. So, starting from here. So at that point, then I wouldn't necessarily be racing to a short out of here, or to do a bearish trade. So the next clean levels of supply, okay, where there was an exhaustion of buyers as opposed to an exhaustion of sellers that I showed you on the level of demand below. Um, that's up here, okay? And so we can see right here, price rallied up here, consolidated right there and dropped, okay? And then up right above it, there's another level that's kind of similar to that, okay? And again, notice each time when it drops with a great deal of energy with a very proportionally larger red bearish candle, okay? And that's the thing that essentially characterizes that's one of the key elements of that supply zone there. Okay, so when price returns, if it would actually then kind of go up to here, again, this is the area that we would not be really looking for any kind of further downward price pressure. And so at that point, then we would actually be looking here, and that's that area that I was just showing you. And at that point, then that's about 5.5% above, about 25 S&P points above. So we would obviously have to have a decent rally to get up there. And in fact, we would, if in doing that, if you see those blue crosses there, that actually represents the 52-week high. Okay, so we would be taking out the 52-week high en route to getting to that supply zone. But at that point, then price would be very stretched to the upside. In fact, if we look right here, that's actually the standard daily upper Bollinger Band, the 2.0 standard deviation, your standard Bollinger Band there. And so this thing would obviously be well above the Bollinger Band. Obviously, if price moves up from here, the Bollinger Band is going to move. But nonetheless, when price gets up here, that would certainly be over the Bollinger Band. So that would indicate that the price is very, very stretched to the upside, and that would create a good scenario to express a bearish trade. And at that point, then, of course, one could short the SPY and the same, but on the other hand, again, the same way we talked about buying a call, rather than doing that, of course, we would obviously then be looking to buy a put up here with the same caveats as before, buying enough time, and then also buying something a bit in the money, so that we're running a delta of, let's say, 55 or 60, so that if we do get the anticipated move, we can actually get a reasonable profit out of the position. And of course, the other thing one could do over here, let's just say, if I'm looking at the demand zone here, in addition to buying a call, one could also sell a bull put vertical credit spread and collect premium. Okay, so that's another way of expressing the trade out of that level. And of course, up here, one could of course sell a um, a bear call vertical credit spread, and the same thing to collect premium. Okay, so that's those are trading levels, the near term trading levels for the SPY. If we take a look at the Nasdaq, the QQQs, so right here, here is what we're looking at right here. And let's just spread that out a little. So this is what we were looking at last week. Again, there is that line from August 4th. Okay, so since then, prices dropped, and we saw that, the evidence of that, of course, when we looked at the index performance, and we saw that the Nasdaq had dropped about 1.5% last week. So right here, it's now sitting kind of in this zone here, and that was the origin of of sort of a bullish move out of here. Because of the structure and the fact that there has been relatively a lot of trading in here, we actually would expect the same thing that we were looking at in the SPY, that price would not get stopped by here, but it would actually get stopped probably by this pivot over here. In fact, price, if you notice, we have that bearish candle, then notice right there that very bullish candle. So that's what we're seeing in the daily chart here. If I actually drop this thing down to a 2-hour chart, we would then see, and let me just back this up here. Okay, here's what that pivot on the daily chart looks like now that we drop this thing down to a 2-hour, and we can now clearly see that reversal there, and so essentially that little area of consolidation in here, and then price rockets and it came out of here with a good deal of energy with these two very bullish candles. Okay, so those are the level. That's the near term demand zone on the Qs. Okay, so that's where we are in terms of the on the bullish side, and then actually the next demand zone down. If this one, let's say, would not hold, then the next one further down, that would be around here, and that's about 3.5% down, so about 3.75%. So you can see right here, this is down about this is down about 1.75%, and then this is down about 3.75. So this is about another 2% down from this level down to that level. So those are your two near-term levels. And again, we would be looking to express a bullish trade out of one of these, depending on the market conditions. Okay. Then on the other, going in the other direction here, of course, here is this an overhead supply zone right here. And if we then look to see what its distance is away from current price, we can see that that's about 2.5%. And if we just get this out of the way here just for a second here, we can see right here, price rallied. Notice it consolidates there. Again, notice that very, very bearish candle that begins a descent, a price swing down from here. So that's an area that we might be looking at. This one is not, I would kind of give this sort of, this more or less would be kind of a B grade setup. The one that I actually really like is right there. Okay, and that's a little further up, of course. So that's about 4% up though, and this is about 2.5%. So this is about another 1.5% further up. But this is actually really the area that I actually think is the kind of the juicy area for a bearish trade. Price rockets, price popped here. Notice it very clearly consolidates, and then notice there's a gap there that begins that price swing down. And again, this is characterized by an exhaustion of buyers out of this level after this period of consolidation. Okay, so at any rate, those are areas where we could express a bearish trade, and that's an area where we could express a bullish trade. And then right below that is that other area that I was talking about in terms of what the next demand zone is below that. And then lastly, we can take a look at the Russell. Okay, so here's the Russell. Here's where we closed. Here's where we were looking at something last week. And this obviously looks very similar, if you recall, to those areas that we saw on the Qs and the SPY. And again, price has come down to here. This level more or less kind of stopped price. It, again, kind of did half of its job, but is not certainly not sent it back up. And now that it's kind of, you can see it's kind of really porous, and it's more or less kind of bleeding through here. We would then expect to see a drop down to this level, and at that point, then this is the origin of another move here. In the 2-hour chart. I'm not actually in love with the structure here, just because there's really no clear consolidation here, but we will certainly still keep an eye on it. And if price kind of digs into this level and then actually starts to then reverse, we would then take a bullish trade out of here. But I wouldn't reflexively just expect it to kind of bounce off of here, and that's a function to a large degree of the structure that we're seeing there. So at any rate, those are your near-term levels on the major indexes. So before we go here, first of all, I want to thank you for the privilege of your time, as always. But what you've seen here is we've actually kind of looking those supply and demand zones. Those are actually areas of institutional buying and selling, particularly because we're looking at them in the context of a daily chart. And so that's and basically those are those areas where supply and demand go out of balance. And so the formal definition of these zones that I just showed you are, again, with the demand zone, there's a sudden exhaustion of willing sellers. Okay, and then when price kind of pulls back, there is the expectation within that not everybody that wanted to buy got the opportunity to do so, because price was in there only for a relatively short amount of time. Okay, and at that point, then it's an area of anticipated upward price pressure. Okay, and if we think about it, this is an area where these demand zones, this is an intelligent and a rules-based way of actually buying the dip. Okay, so people always talk about buying the dip. Well, some people just kind of just do it, and really, when they buy the dip, it's like, well, I hope it's going to bounce from here, but they really don't have a concrete reason as to why. These demand zones are areas that we can, in fact, there is strong evidence over decades of observation that you will get a price move out of these a reasonable percentage of the time, and that's of course the basis of our trading methodology here. Similarly with supply zones, the same exact thing, except in reverse. Okay, so again, thank you for the privilege of your time. And if you like what you saw here and you enjoyed the presentation, if you would give us a like in our YouTube channel, subscribe to our channel, and also you will see a link where you can actually schedule a call with me. And I would be happy to tell you a little bit more about these supply and demand levels, and essentially kind of how we use them as the basis for high probability controlled risk trades, and in particular, how we can construct really good, intelligent options trades. Okay, so again, thank you for joining us, and I will see you next time. Take care. Bye-bye.